In this video, we'll review bond basics. And I say review because you would have seen this material in the prerequisite course, Basic Financial Management. We'll cover coupon bonds and zero coupon bonds briefly, and we'll talk about bond pricing because bond prices determine interest rates, and interest rates determine bond prices. It's a big component of this course. Then, using a supply and demand framework, we'll analyze factors that influence bond prices and hence interest rates. We'll compare and contrast the pricing of loans to the pricing of bonds because they're very similar. Now, loans tend to be very illiquid. They don't trade. You and I can't buy loans, but nevertheless, they're out there. And the process of securitization turns these illiquid loans into liquid mortgage-backed security bonds that trade in the bond market. Now let's go jump into the material. Okay, so what I want to do over the next few minutes is review bonds and their pricing and how their cash flows are structured. And I'll look at coupon bonds, which are basically called fixed income bonds, fixed income securities. And we'll look at zeros briefly, a type of bond. And then what I want to do is I want to relate this to loans because bonds and loans are very similar. So you have a price of bonds because that's in the bond market. And then what you probably don't know is that there's really a market for loans out there. And so how do you price a loan? Well, that's what I'm going to cover. So first off, let's look at an example of a coupon bond. So let's say we have a coupon bond and we say the coupon rate is 3%. And I'll explain how this works, but let me just give you some of the data for the bond. The bond's going to have a face value, and we're going to have a maturity, and I'll call it M. And M is M years in this case. Most bonds pay semi-annually, but I'm going to show you the math on an annual basis because it's just simpler. And the intuition is basically the same, except that when you have a semi-annual bond, you got to chop this in half, this coupon rate in half, and you double the number of periods because then you have 6 semi-annual periods that pay 1.5%. Let's get away from that. Let's just keep it simple. And so we can draw a timeline of the cash flows. And here's the cash flows for a 3-year bond. So the cash flows are going to be 3% times the face value. So you're going to get $30, $30, and $30. That's the interest associated with the bond. And then you're going to get your $1,000 face value back when you buy this bond. So the question is, what is the price of the bond today? Well, the price of the bond today depends on where interest rates are. What is the bond's yield to maturity? So coupon bonds are fixed income securities. They're fixed in terms of the timing of the cash flows. The indenture tells you when it's going to pay. So every year, or in some cases every 6 months, the bond will pay. And not only will it pay in fixed points in time, but the amounts are fixed in time. There are some securities called floaters where the coupon rate floats up and down with interest rates in the economy, which means these cash flows change. And if these cash flows change based on changes in interest rates in the market, it means the price of the bond is going to stay fixed. Let's stay away from that for now. Let's just focus on a fixed rate coupon bond like you saw in Finance 320 or your previous finance course. That's a prerequisite to this Markets and Institutions course. So how do you price the bond? Well, let's just assume for the moment that the yield to maturity or the interest rate in the economy is also 3%. And what that means is, look, this bond is generating cash flow at 3% for you in interest. And the market wants 3% because that's the opportunity cost of money. Then what's going to happen is this bond's going to trade what's called flat or at par. It's going to trade for $1,000. How do I know that? Well, we're going to discount each cash flow back at 3%. So you take this cash flow, discount it back at 3%. This will be in present value terms, $29.13. This will be $28.28, and then this amount will be 1,030 divided by 103 to the third power. And that's present value of $942.60. So if you were to reverse this process for a second and say, look, I want something that pays $30 in 1 year. What's it worth today given interest rates are 3%, given that 1 year right there? So it's worth $29.13. So if I invest $29.13 for 1 year at 3%, I'll get $30 back a year from now. That's the way to think about it. And so if I'm going to get $1,030 in 3 years, what's it worth today? It's worth $942.60, because if I invest $942.60 right now, at this point in time, I invest it for 3 years, 3 years at 3%, I'll end up with $1,030. So this is the present, the price of the bond is the present value of its future cash flows. That's, the cornerstone of finance. So now what happens if interest rates change? What happens if interest rates go up? They're not 3%. Let's say they're 5%. Well, if interest rates are 5%, then what we're going to have is we're going to have a 5 here, a 5 here, and a 5 here. So you just increase the denominator, which means this whole fraction, the fractions are going to go down. And what that means is this amount will be now, this will be 2857, this will be 2721, and this will be 889.75. And the sum of these is the price of the bond, the value of the bond, given interest rates are 5% now, and this coupon bond is 3%. The bond throws off 3%. Then this comes out to be 945.53. So this bond trades at a discount. It's unattractive because interest rates went up. The opportunity cost of money in the economy went up. But this is a fixed income security. The cash flows are fixed. So the value of the bond fell. The bond trades at a discount. Discount relative to what? Discount relative to face value, as shown right here. Now, if interest rates fall, you can do the math and drop it to 1%, and you're going to see that the bond will trade. The price will end up being higher than $1,000, and the bond will trade at a premium. Why? Because the market, if the market wants an interest rate of 1%, that's the opportunity cost of money, and this bond earns 3% cash flow. See that cash flow of 3%? This is an attractive bond, so investors bid it up. So always keep in mind the benchmark case is the coupon rate and the market interest rate are the same, then the bond will trade at its face value here, like I computed at $1,000. Now, just relating it quickly to a zero, so I just covered this component. Now, if I look at a zero coupon bond, you can think of a zero coupon bond as, look, you buy a bond that has no intervening cash flows. The coupons are zero, so all these would be zero, and then you have it maturing at $1,000. So if interest rates are 3%, and this is 3 years, so there's 1, 2, period, year 3, what is the price of this bond today? Well, it's $1,000, and if interest rates are 3%, you discount that back, and let's see, 1,000. We get this bond is worth $915.14, and that would be called a zero coupon bond. You can think of each one of these cash flows as being a zero coupon bond, which means for our purposes, it's really convenient, because if you want to see the inverse relationship between bond prices that I just showed you and interest rates, if you have a coupon bond, you got to go through all this math. But if you just think of a zero coupon bond, and each one of these is a particular zero coupon bond, this matures 1 year from now for $30. What's it worth? Well, with a 3% rate, it was worth $29.13. You can get a zero coupon bond that pays off in 2 years. No cash flow here, just one bond that pays off $30 in 2 years from now. What is it worth today? At time zero, it would be worth $28.28, so on. So if you had a $1,000 maturity, if you bought a zero with a face value of $1,000, it would be worth $915.14 today. Or reverse the process, if you invest $915.14 at 3% for 3 years, you'll end up with $1,000 in 3 years. So my point in covering zeros, you don't have to go through all of this math to see the inverse relationship between interest rates and bond prices, just look at a zero. It's like so much easier. It's just one cash flow, and you can see that inverse relation. Now what I want to do is let's relate this to loans, because we're in a course of financial markets institutions. We're talking a lot about banks. And you know, there's a market for loans out there. Banks and other financial institutions buy and sell loans off their portfolio, out of their portfolios. So let's take a brief detour and look at why a bank might want to change the composition of its loan portfolio. Then we'll jump back to comparing bonds to loans. So why would a bank sell some of its loans? Well, it will sell them to a bundler, for example, so they can be securitized, as we'll talk a little later in this video. They will also sell them to get cash so they can make new loans and collect more fees. And then they also sell their portfolio to, and sometimes buy, to shift their portfolio around, to shift the composition of their portfolio so they have a diversified portfolio and they can better manage their lending risks. So let's go back to comparing bonds and loans. So let's go back to the bond we just looked at. 3-year bond. We said it had a coupon of 30, 30, 30, and then a return of principal. This was a bond, had a face value of $1,000 and a coupon, basically the interest rate that it paid was 3%. Okay, so that's a bond. So if a bank owned this bond, and banks often own bonds, they're a significant part of their portfolio, then, okay, they're going to make 30, 30, 30, and get a return of principal of the $1,000 that they lent out when they bought this bond. So they bought the bond here at some price. They're going to get that $1,000 back. Now, why can't we just flip this over and say, look, you know, this is a loan with a face value of $1,000 and not a coupon, but just the interest rate, the rate on the bond. And let's say it's 3%, and the loan is structured, hypothetically, the loan is structured so the bank is going to receive 30, 30, and 30, and then get its principal back that it had lent out at this point in time. So basically owning a bond and owning a loan, pretty much the same thing. I mean, in terms of cash flow, I'm talking strictly in terms of time value of money and cash flow. Obviously, the risks are going to be very different, but from our perspective here, that you can translate a bond, and you can toggle between a bond and a loan pretty quickly for the analysis. And that's the point that I want to make here. Now let's discuss securitization and use what we just learned about the close relationship between bonds and loans. So let's use our imagination and go back to the same bond we've been looking at. We have a bond that has 30, 30, and 30 plus 1,000 in terms of principal payment. Now, let's think of this as a mortgage loan that a bank holds. Now, what do you think happens if a bank ends up with dozens and dozens, if not thousands, of mortgage loans on its books? It's generating cash flow periodically, right? What if it was to sell these mortgages to what we call a bundler, where they literally bundle all of these mortgages? They'll buy thousands of mortgages and process them and turn them into bonds. So think about thousands of mortgages, and let's just say there's for our sake at this point, to make the math easy, there's 100 different mortgages that they're buying, and they all happen to have the same cash flow. 3% mortgage. Oops. And what we have is we have all these mortgages, and if you add this all up, and the interest on these 100 mortgages in total would be $3,000, $3,000, and then it would be $100,000 in terms of the principal coming back. Okay? So they just aggregated all these loans, And what if the bundler takes these and now sells this cash flow in terms of a bond? So this is generating cash flow, and if you package it into 100 bonds, and now they can sell these bonds in the bond market, which is very liquid. Here you got very illiquid mortgages. You and I can't buy mortgage loans. You can buy them on, if you're an institution, but you can't buy them on an individual level. And so we're precluded from these markets as individuals, but bundlers can package these things in the bonds called mortgage-backed securities, because these bonds, right, there's 100 of them, so each one throws off $30, $30, and $30, and then $1,000 at the end. These bonds are basically the same thing as a mortgage loan, but they're mortgage-backed securities. The point that I'm trying to make here is that if we have bonds, and bonds have a price, these bonds have a price. We just saw how to price bonds, right? We can price this bond, or these 100 bonds here, right? We can price that bond easily. We just saw it was $1,000. Well, we can price a bond. You can price a loan. And a loan is nothing but the present value of its future cash flows. So the value of this loan would be nothing but a present value of $1,000 if interest rates in the market at the time are 3%. Because the loan generates 3%, the market wants 3%, so the loans are priced at par, face value, $1,000. The same thing could happen with the bond. And if these bonds generate higher income than 3%, they're going to be trading at a premium. And these loans will be trading at a premium also, if the interest rate that the loan generates is higher than the going market rate of return, and vice versa. Now, there's a couple of caveats I want to make that you need to be aware of in this comparison. Well, it's a really nice comparison. It's deficient in a couple of important things, and that one of the most important area is the fact that I haven't addressed prepayment risks. People who have mortgages rarely hold the mortgage for its lifetime to its maturity. Let's just say this goes off to 30 years. Very few people hold their mortgage for 30 years. And why is that? Well, individuals tend to prepay their mortgages early. They pay a percentage of the principal, of more than what they're required to over time, and that can substantially reduce the life of a mortgage, which means it reduces the life of these bonds. So these bonds are at risk of being paid off early. You may get your money back way faster if you buy a mortgage-backed security that has 30 years. Well, you're not going to find one that has 30 years because most mortgages go 30 years. And so if the mortgages are 30 years, there's no way these mortgage-backed securities will go 30 years in general. And the other it's not just because of prepayment risk. So prepayments, just in general, prepayments by mortgage holders. But often what happens is mortgage holders sell the underlying property. When they sell the underlying property, they pay off the mortgage. So this mortgage never lasts 30 years, rarely lasts, because a lot of people sell their house in 30 years, which means when they sell their house, they pay off their mortgage. So the cash flow comes back very quickly, much sooner than anticipated. The other thing that you need to be aware of is that when interest rates fall, mortgage holders want to refinance. They refinance their mortgages at lower rates. Well, when they refinance their mortgage at a lower rate, they pay off their mortgage. So between these three things, the average mortgage only actually lasts about 10 years. Which is why a lot of mortgage rates are benched off of the 10-year Treasury bond. So you have a 10-year Treasury bond yield. Let's say the 10-year Treasury bond yield is 2%. And then what happens is they tack on some risk premiums because obviously mortgage holders, these people who are borrowing, they're not the U.S. Treasury. So there's a lot of risks associated with it. These people can default. And we'll have a lot to say about that, especially with the subprime crisis in the Great Recession. So there's going to be risk premiums tacked on to here that'll make them higher. But my point is, these mortgage-backed securities are risky because of the possible defaults that go on here and the possibility to get your money back way earlier. And especially this area right here where we have refinancing. Refinancing happens when interest rates fall. And what that means is to a mortgage-backed security holder is they get their money back early when interest rates are low. They have to turn this money back over, reinvest it into very low interest rates. And so that could be a problem. So mortgage-backed securities have default risk in them, and they also have what's called prepayment risks in getting your money back at the wrong time when interest rates are really low. So now let's move on and look at the supply and demand for bonds and how to model that. We need to develop a framework for it because bonds and interest rates are going to be a very important component of much of this course. And it's really important to understand how bonds and interest rates behave and what influences them, because the Federal Reserve is going to be looking at this very closely. That's one of the largest financial institutions in the world. We want to better understand how the Federal Reserve tries to move and manipulate interest rates. It won't control interest rates, but it manages interest rates. What is it looking at, and what drives bond prices? So we need to look at how these bonds interact in terms of supply and demand and the factors that influence them. So now, before we move into the supply and demand for bonds, I think it's worthwhile just to back up for a second and cover some introductory material so that we make sure that we have a good understanding of the basics. And to do that, I'll cover the supply and demand for a particular good. Let's say gasoline. It's less abstract. So if we make sure we get a good handle on this, it'll be a lot easier to transition into the supply and demand for bonds. So let's look at the supply and demand for gasoline. And we're going to have a downward sloping demand curve. It's sometimes called the law of demand. It's downward sloping. What it means is if the price goes up, quantity will go down. And if the price goes down, quantity demanded will go up. And we call this a curve even though it's a straight line. It's typically graphed as a straight line, although in some places you'll see it curved. Often just a straight line. And so let's say it's $2 a gallon and we have a certain quantity demanded. Now I didn't specify the market, and I could just say, look, this is the US. We're going to look at supply and demand for gasoline in the US. Sometimes it's convenient to drop down even to a micro level and look at the supply and demand for gasoline in a particular gas station. And then you can make it a little more even, basically more concrete, I think. Because then you can actually derive a demand curve for a particular gas station pretty easily with empirical data. So one week you set the price of gasoline at $2, and you recognize and you see your sales receipts. You sold this many gallons. Then the next week you drop your price of gasoline to $1.75, and assuming, and this is a big assumption, nothing else in the world changed besides the price, then you should see an increase in demand, and you can figure out, the slope of this demand curve and so on. And what you should see is an increase in the quantity demanded. Okay, so let's go back up to the national level to do our analysis. When we change price on this axis, then we slide along this demand curve. I can't emphasize that enough. If we change price, we're sliding along this demand curve because we're holding everything else that affects demand fixed. And so what we need to do is we need to ask ourselves, well, what are some of the factors behind this demand curve besides the price? And so we can list them. We'll list some of them. It's not going to be exhaustive. If you go into an economics course, generally you start out small and they'll list a few items that will affect demand other than price. Then as the course unfolds, they'll add a few more. Let's just get the basic concepts down. So if the number of consumers in the US goes up, then we're likely to see an increase in demand. So we're going to have a demand curve. So maybe we label this D0, this D1, and the demand curve shifts to the right here. And we often have it here as an up arrow on the demand. And so what we say is it's often convenient to say, look, at this price, the quantity demanded will go up. when there's an increase in the number of consumers because demand goes up. In some cases, you could interpret this as if you keep quantity fixed. Somehow you could restrict quantity and keep it fixed in the U.S. Then what would happen is the price of gasoline would rise as you get more consumers. Another item would be the price of substitutes. And what would be a substitute for gasoline? Well, an electric car battery would be an example, like an electric car battery in Tesla. Now, if the price of electric car batteries increased, right, electric car batteries go up in price, then the demand for gasoline will go up because people will more likely want to buy gasoline guzzling cars than a Tesla. So you'd see a demand curve that shifted out to the right. You also could have tastes and preferences of consumers. Now, you know, in the summer, people tend to drive more, gasoline demand goes up. And so that demand curve, we're not changing price, it's going to move this demand curve out. Okay? Tastes and preferences, especially around seasonality, could have a big impact on demand. Now, that's just the demand curve. Let's go into the supply curve. So we have an upward sloping supply curve. Again, we call it a curve even though we model it as a straight line. An upward sloping supply curve is often called the law of supply. So when prices go up and you move up this way, think of it experimentally. You ask, well, what happens if you change price? What happens? What's the impact down the line? And the impact down the line is, in this case, is we're going to be on the same supply curve because all we're changing is the price. And we're going to have an increase in quantity supplied. And the reason for that is producers are going to want to produce more because when the price goes up, sales revenue goes up, their margins go up, and they're going to want to supply more. They'll even devote more resources into producing gasoline and pull resources away from other areas in order to supply more. If the price of gasoline comes down, then we're going to move down this, then it becomes less profitable for producers to sell gasoline. They may shift resources away from gasoline production into other types of production, maybe diesel fuel, maybe kerosene, maybe other type of petroleum products. So when I change price and I'm holding everything else constant, what am I holding constant? What are the important factors? Well, it's the number of producers. So I'm holding those constant. Now, if the number of producers go up, then you can imagine the supply curve is going to shift out to the right. And if we started right here at point 1, then at each and every price, then we're going to have more quantity supplied, which kind of makes sense. That's pretty intuitive. Another factor would be the price of inputs. The main input to gasoline is crude oil. So if the price of crude oil drops, then there's going to be an increase in supply. Supply is going to shift out. And why is supply curve going to shift out, say to S1? Because profit margins increase. So the price of crude oil drops, profit margins for gasoline will increase, all else being equal, and producers will produce more. Another cause for the shift of the supply curve out to the right would be an increase in technology. Very vague term. I think it's pretty easy to wrap your head around if they use more technology that you can reduce costs, and that's one reason for adopting that technology. But technology is very difficult to pin down in economics. It could even be not just the adoption of equipment and computer systems to better automate the production of gasoline, but it even could be how producers arrange their facilities. Basically the same, in my mind, the same technology, but rearrange their production process. That could actually increase their productivity. And so technology and productivity go hand in hand. So if you increase the technology or you increase productivity, then the supply curve is going to shift out sometimes we say up, but we got to be careful here because up kind of means this way. So supply curve shifts out to the right here. So here, each one of these items is a supply shift to the right. So when technology goes up, it's very similar to the price of inputs coming down in effect. So again, that's not an exhaustive list. There'll be much more, but I just want to get you some, just the basics here. And let's now move on to supply and demand. Let's look at of gasoline modeled together here. So here we have the price, here we have quantity, we have demand, we have supply, and we have an equilibrium. So this is the equilibrium price, and we have an equilibrium quantity here. Now, how do we know that's an equilibrium, and what do we mean by an equilibrium? Well, equilibrium means there's no tendency in the market to change. And if we had a price that was higher than this equilibrium price, say called PE for equilibrium, if the price was up here, let's see what happens. Ooh, supply would exceed demand. Well, there's a lot of supply out there. What are producers going to do? They're going to drop price. So then when they drop price, they're going to move along these curves, and eventually price comes down to the equilibrium price because there's excess supply. They want to unload that gasoline. And then what if prices were set really low? So if you could artificially push the price down for the moment, what would happen? You'd have excess demand, which is a shortage. The shortage would be this amount between my fingers here. The excess supply here was this amount. So you'd have this much in terms of excess demand, and so you would have pressure on prices to go up, and prices would go up until you reach this equilibrium where supply equals demand. So now let's model it again together. Price, quantity, demand, supply. We start at an equilibrium. If demand shifts to the right, we have increased demand, we travel up this supply curve, and we end up at a new point, a new equilibrium, if nothing else changes. If the number of consumers increases, or it becomes summer and tastes and preferences for gasoline go up, then we're going to see the price go up. And we stick to the same supply curve. This supply curve doesn't change. So all the factors that we looked at behind the supply curve are fixed. If the number of producers of gasoline falls off, then the supply curve will shift to the left. And if we start right here at this point, ignoring this initial shift here in demand, if we just have a shift in demand to the left because the number of producers drop off, then we're going to move to point 2. We move up this demand curve because we're not changing anything else associated with demand. We're not changing anything with the demand. All we're changing is there's a change in supply, the number of producers. And we move up, if you can see that, to this new point, basically an arrow up to this point, point 2. And we end up with a higher price, all else being equal, compared to what we were before. Now, before we go on the bonds, let's look at one scenario that's going to be interesting in this gasoline example. So let's start out. You always start off at equilibrium, by the way. You don't ever want to start off in disequilibrium. For example, you don't want to start off in some form of disequilibrium, because then first you have to explain, well, why do you have disequilibrium in the first place? Why do you have an excess demand, a shortage here? Why do you have an excess supply here? So you always start out assuming an equilibrium. We have demand, we have supply. So what happens now if the expected future price of gasoline goes up? Suddenly you expect the price of gasoline to go up. It hasn't gone up yet, but we expect it to go up. Now the important point here is to recognize this is the current price of gas right now. It's not the expected price of gas. So when the expected future price of gas changes, it's going to shift these curves. And so if the expected future price of gasoline goes up, the average consumer can increase their demand, buy gasoline now and increase demand. So the demand curve will shift out, D1 to D0 to D1. Demand curve shifts out because we can time our consumption of gasoline to some extent. as consumers, and we'll push our purchases up now. And then when the price goes up, we'll just buy less of it at that point. So our demand curve for right now, given prices, will increase. Well, what about the suppliers now? Well, suppliers, they see the expected future price of gasoline is going to go up. They're going to restrict supply at this point because they're going to want to get that higher price. So they're going to restrict supply, and we're going to move in this direction with the supply curve. So we started out, let me use green here, in point 1, and we ended up at point 2. And so what happens is we have an increase in price because of that, which makes sense. We're going to end up having an increase in price now because there's going to be more demand and there's going to be restriction in supply, and we move at this point, unambiguous. So we know for sure there's going to be an increase in price. We don't know if the quantity demanded will go up or down. I have it basically the same. The quantity hasn't changed, but depending on which curve moves further, we could end up with less quantity at equilibrium or more quantity at an equilibrium. Okay, so with this in mind, let's move over to supply and demand for bonds. With this in mind, let's move over to the supply and demand analysis for bonds. Okay, the first thing we want to keep in mind is recall what a bond is. It's the present value, it's future cash flows. They're called fixed income securities because the payments here are fixed not only in time but in dollar amounts. And then at the end, so think of these as coupon payments plus a coupon payment plus the face value at the end, at maturity, whatever time period that will be. So when you buy a bond right here, time 0, all of this is fixed. It's already been established. So that's the important point. And then we take this and we compute the present value, and we add up the present value of each one of these zeros. You can think of it that way, and you have the price of the bond. Okay, so you're buying an annuity plus a $1,000 face value that comes at maturity. So now what we want to do is let's look at the demand for bonds. So we have price of bonds here, we have quantity of bonds on this axis, and we have a downward sloping demand curve. Now, before we go further, keep in mind that you change price, then you move along this demand curve. You're not shifting. And what we want to do is a couple things. We want to look at what are the factors that shift this demand curve. And then, why are we modeling price when we're really interested about interest rates? Interest rates are often the way bonds are disclosed and priced. So what do I mean by that? You'll rarely see the bond market described in terms of bond prices. It's almost always in interest rates. So they'll show you a yield curve. They'll talk about changes in interest rates because bonds have different face values. Some bonds have a face value of $1,000. Some bonds have a face value of $5,000. So there's different face values, and so you'd have to specify, well, which face value and so on. You don't need to do that when you just talk about interest rates. And the point that I'm trying to make is when you have a price here and a quantity, okay, the quantity is straightforward here, but here this price also signifies an interest rate. Because once you've determined the price, it's based on the interest rates of computing the present value of these cash flows. So interest rates determine the price, but if you just set the price and you move price, it changes the interest rates. So the interest rates and prices are determined simultaneously. So when you're looking on this axis, we're raising prices when we go up. But when you raise prices as you're going up, it means interest rates are falling. And when you're coming down, it means prices are falling, but interest rates are going up. So when you think of prices here, you need to flip your mind around and take the inverse and say, okay, prices went up, that means interest rates went down. And when prices go down, that means interest rates had to have gone up. So now the question becomes, what are the factors that shift the demand curve? And I've got them laid out here. First one is an increase in wealth will cause this demand curve to shift out and to the right. So you start off D0, call this D1, and then at each and every interest rate, you would have more demand if you had an increase in wealth. Which that kind of makes sense. That's kind of consistent with the story of gasoline. If income of consumers went up, so if income went up, then the demand for gasoline would go up. Well, if wealth went up, people will buy more bonds. They'll demand more bonds. It'll shift the demand curve out. The next one is if we have a reduction in expected inflation. A reduction in expected inflation will increase the demand curve and shift the demand curve. And so how do you interpret that? Well, think of it this way. Buyers like you and I and institutions that buy bonds, if they see that inflation is expected to go down, remember, these payments are all fixed. And if inflation goes down, that means these things are staying fixed. These payments are worth more to a bond holder. And so that's going to increase the demand. And by the way, as I go down here, like you could have done with the gasoline example, is you should, on your own, think about what happens if wealth decreases. Can you model it? And obviously that would be just a shift here downward. And what would happen if inflation increased? And then if inflation increased, you'd have a shift down. But then can you explain it, though? And that's what you need to think about. And I'll let you do that on your own. I'm going to cover just the one direction here. So now the third thing that can affect bond demand is there is a decrease in expected future interest rates. Ooh, wow, that kind of sounds like expected future gasoline prices that we were looking at earlier. This is a decrease, in this case, of expected future interest rates. That's going to increase demand for bonds that exist. So this existing bond is more valuable if expected future interest rates are going to go down. If expected future interest rates are going to go down, people are going to buy these bonds up, this bond, because it's going to have high payments. So that's an expectation concept. Now, the next one is if there's an increase in the expected return relative to other assets. So if these return, the return that you're getting here and the annuity payment you're getting plus the face value, if that return is higher than other investments of comparable risk, now I should make that point, of comparable risk, then demand is going to go up. That's pretty intuitive. The next one here is if there's a decrease in the riskiness of bonds relative to other investments. Let me move this up here. So if the riskiness in a bond drops off, it's more attractive because everything else is staying constant with that bond, but its riskiness drops. That means that bond is more attractive relative to other investments, and demand is going to go up. Okay, so now with this, let's move on to the supply side. So now we have price, we have quantity of bonds supplied, and we have a supply curve. Okay, so again, if you just change price, you're going to be moving up and down this supply curve. So the next question becomes, what drives this supply curve to the left or to the right? Let's look. Keep in mind that where does the supply come from? It comes from issuers. Who are issuers? Well, businesses, corporations that issue bonds. It could be municipalities. It could be governments. They're the primary issuers of bonds. So when we have improving business conditions, there's going to be an increase in the supply of bonds. So supply curve is going to shift from S0 to S1. It's going to go to the right. That makes sense. Stronger the economy, then the more likely you're going to have companies issuing bonds. So here you got a balance sheet. Here you have assets, liabilities, and equity of a company. And the company is going to issue bonds here. So this will go up. And then the money is going to be used to finance investments because they're going to want make more investments when business conditions are improving. It's basically we're on a business cycle and things are going up the business cycle this way. So we're getting a stronger economy. And so businesses want to respond to that by expanding. Another thing that will increase the supply is if there's an increase in government expenditures relative to revenue. So if there's an increase in expenditures relative to revenue, the government's going to issue bonds to finance that. And so that's going to shift the supply curve out. Now, I think what's important is we should look here for a second and put a demand curve in just to see what happens. Notice what happens. If the government starts issuing more bonds, and it seems to be frequently doing that. So let's think about why there's an increase in government expenditures relative to revenue. So this is important because, you know, we constantly see the government increasing the budget deficit. The budget deficit keeps going up, so expenditures are greater than revenues, which leads to the government issuing more bonds. The government's issuing more bonds to finance all those expenditures. So what are the implications of that? Well, like I just said, the supply curve shifts out to the right. But what happens is, you can see prices drop. Bond prices drop because supply, they're flooding the market with bonds. The government floods the market with bonds. Prices go down, but interest rates go up. Okay, so remember that. So interest rates are going up because of this action, which will tend to crowd out the businesses, corporations and other businesses that want to expand. That is a problem for the business sector, the government crowding in them out. It's something that's often discussed in economics, that the government issues too much in terms of bonds. It has negative consequences for the bond market and interest rates. And also, by the way, it also hurts prospective home buyers. So people who are considering buying a house. So if you consider this to be the balance sheet of an individual, the individual will get a mortgage and use it to buy a house as an asset on the asset side. But if the government has issued more bonds, then interest rates go up and mortgages become more expensive. And that's going to have an impact on the housing market. So the fact that the government issues a lot of bonds has a ripple effect that goes throughout the economy. It affects the business sector, and then it affects individuals through the mortgages, and then it affects housing prices and demand for housing. Okay, the last one we want to cover here is if there's an increase in expected inflation, supply goes up. Ooh. Expected inflation goes up. You know, we talked about expected inflation when we looked at demand, and we said that when there was a decrease in expected inflation, it caused demand to go up. In this case, it's going to cause supply to go to the right. So how do we explain that? Well, back to the story here, that a bond is, there's a series of payments here that are fixed, and you have the price of the bond. And so what happens is, with expected inflation going up, the issuers can make those payments with inflated dollars. And so when inflation goes up, oh, the government wants to issue, all else being equal, the government could issue more bonds and businesses can issue more bonds. And that's where the supply is going up, because they're going to pay with inflated money. They're operating in an economy where prices go up. Those fixed payments on a relative basis are falling. And so that's going to drive the supply curve out to the right. Now, what we want to do is let's look at a couple of scenarios where there's where there's more than one change going on. So we modeled these things as simple one-off changes in the supply and demand curves. But, you know, the world is pretty complicated. So let's look at situations where there's more than one change going on. The demand curve changes, the supply curve changes. And let's see what we can glean out of it. Okay, so let's look at what happens when the business cycle is improving. We're going up in the business cycle. So here's the business cycle. And so business conditions are improving, which means we're going up the business cycle. So maybe just say conditions. And so what we want to do is we want to model that. Let's look what happens. Well, there's implications here to both supply and demand. So we start out right here, quantity of bonds. And we know that, look, we know the demand curve shifts up and to the right, because what's happening is income is going up at this point. Wealth, I should say wealth is going up. We just said that when wealth goes up, it's going to be a shift in the demand curve. So the demand curve shifts out 0 to 1. And we go to this point at the moment. Okay, so let's see. Does that make sense? Not quite. What it's telling us is, wait a second now, it's telling us interest rates have had to have declined because prices went up. Interest rates had to decline. And that doesn't make sense at this point because we know that when the economy gets strong, interest rates tend to go up. So interest rates tend to go up. And when the economy weakens, interest rates tend to fall. This doesn't fit with empirical evidence that we have over all the years of looking at the bond market and the economy. It just doesn't fit. So what are we missing? Well, we're missing the fact that when the economy is stronger, then businesses are going to want to sell more bonds, issue bonds, to be able to expand. That story we just covered a few minutes ago. So what that means is we need to shift the supply curve out. So it goes from 0 to 1. And we started out at this point, and we ended up at this point too. Now let's ask ourselves, does this make sense in terms of the effect on interest rates? Well, the way I drew it at this point, it looks as though interest rates are unchanged because basically I have the price unchanged at right about here. So it's unchanged. This looks pretty much the same. We know for sure, unambiguously, that quantity has gone up. No doubt we have a change from Q here to Q here. So the quantity certainly went up. But look, the way I drew it here, that's not quite right because I just told you the interest rates go up. So I have to expand this even further, this supply shift. Okay, and let me extend my demand curves here. And so when I do this, I get a new equilibrium right here, which shows up as a decline in interest rates. So, okay, or I'm sorry, a decline in prices, which means interest rates went up, consistent with this story that towards the peak you have higher interest rates, and as we go down we have lower interest rates in the cycle. Okay, that wasn't so bad. Now the next one is focused on an increase in expected inflation. So if you recall a few minutes ago, I said that an increase, a change in expected inflation, future inflation, so I should make sure we say that, future inflation, that it affects both the supply and the demand curve. So here we are in equilibrium. Okay, so let's look at the demand effects. First off, I said, if you rewind a bit, I said, look, if there's a reduction in expected inflation, demand goes up. So if there's an increase, in this case, an increase in expected inflation, that means the demand curve shifts to the left. D0, we got D1, and we're right at this point here. And so at this point here, prices have gone down, and interest rates had to have gone up. And the intuition goes something like this. Well, if you have a bond and all the payments are fixed and then inflation goes up, those payments aren't worth as much. So the demand is going to shift to the left for bonds. Now with supply, we said not many minutes ago, only a few minutes ago, that an increase in expected inflation leads to a supply shift out. Okay, supply shifts out. And we're at a new point right here. So we started out at this point, we ended up at this point right here. Call this point 2. So let's see what happened there. Well, it's kind of ambiguous as to whether or not the quantity of bonds increased or decreased, and we're really not that concerned about that part of it. What we're concerned about is what happened to interest rates. Prices fell, so interest rates had to go up. That looks like it's consistent with an increase in expected future inflation. That does make sense. So now I could leave it at that, but I want to do one step further with this situation with an increase in expected future inflation. And the reason for that is sometimes you can get confused when you do analysis of what's going on with bonds if you don't look precisely at the timeline of how things work and how expectations work, especially around inflation. Inflation expectations can be tricky, but they're an important part of the story throughout this course. Let's look at some a little bit more in detail how this works. Okay, so timing is really important in considering this situation. So we're going to look at what happens when expected inflation goes up on bonds. First off, let's draw the timeline. Let's just go to draw one period. And we're going to look at this one period and realize that you buy a bond right here at time 0. That's when you buy the bond. And you have to have expectations. Here's a little E, that expectations, or you have an expectation for the inflation rate over this next period. Before you buy the bond, you want to know what that, you better have some type of expectation for the inflation rate. Because it's important, because using the Fisher equation, the nominal interest rate equals a real rate of return plus an inflation expectation. And so this is the return the bond generates. This is expected inflation. The difference between those two is going to be this real rate. And so this is going to be this period when you buy a bond that lasts just 1 year, you have to have an expected inflation rate here, just for example, just a 1-year bond here. So now let's look at some numbers. Let's plug some numbers in. Let's say interest rates are 3%. The bond generates an interest rate of 3%. And then expected inflation is 2%. That means you back into this unobservable real rate of return, which is the gain in purchasing power, is going to be 1. So if you buy a bond that generates a 3% return, 2% of it's just keeping up, is just helping you keep up with the pace of inflation. You're going to gain 1% in purchasing power. You're not going to gain 3% in purchasing power, just 1%. So that's the real implication. So notice now what happens if the expected inflation goes up suddenly. So you buy the bond right here, you buy the bond, and the second later, expected inflation is expected to go up. Expected inflation is likely to rise. The Fed came out with a report. Some forecasters said inflation is going to rise, and so suddenly inflation expectations go up. Let's say they go up to 3% right after you bought this bond. And so this is fixed. This 3% is fixed because, look, all those payments are fixed, and that's the nominal rate of return that the bond generates. This went up to 3%. Ooh, your real rate of return now is 0 because the bond generates a 3% return. Inflation, the price of goods and services are increasing at 3%. You've gained nothing in purchasing power. You're just keeping your head above water, basically, here with this bond. So when expected inflation goes up, the real return, the bondholders, goes down. That's why demand drops off. It's consistent with that story. Now, let's look at this from the supply point of view. If this holds for bond investors, bond holders, then this is going to hold also, this equation will hold for the issuers. So if real rates drop because inflation goes up, then that means the real cost of borrowing for the firms is going to go down. And so that means supply is going to go off to the right. It's going to increase. And so what's going to happen here is that when you buy an existing bond and expected inflation goes up, right, the real returns are going to fall on these existing bonds and demand is going to drop. There's going to be suppliers wanting to issue more. And that means these new issues, all the bonds that are issued going forward after you buy the bond, are going to have a higher nominal rate in order to keep the required rate of return, in order to get this real rate of return up. So what's interesting about a change in expected inflation, and in this case, an increase in expected inflation, is that bondholders lose, and hence the demand curve shifts to the left, and bond issuers gain, hence the supply curve shifts to the right, all under the assumption of ceteris paribus. We changed no other factors that influence bond prices, including nominal rates, as we left that unchanged at 3%.